So this is going to be a pretty no real agenda. We're just going to kind of talk about um, some of the trickiness of the next few steps of the ALIN pool, so that everybody's on the same page. And if anybody's having troubles or needs some questions answered, we'll have a little bit of an open Q&A. So pretty much the investment window of the AMA will be concluding today. Let's see what it's at right now. I haven't checked it. I literally got out of bed 20 minutes ago. So we are at 174,000, let's call it. So we've got a little under 12 hours to go. When the investment window concludes later today, the next phase of the public sale is what they call the deal window. So during this time, I think we've got about a week where the team will have a discussion with the community in the governance forums channel that you'll get when you get the ship crew. So make sure once you take part in the pool that you get the ship crew role. You just have to use the collab land bot for that. So we'll have a discussion in the governance channel. We'll come up with a final proposal, which will be the deal that will get submitted to ALIN. So as an example, we might say offer a deal that says we'll sell 10% of the load supply for $200,000, and then that at that point you would know what the fully diluted valuation of load is going to be. So in that circumstance, just as an example, it would be $2 million, right? So 200,000 times 10, 2 million. And then once the deal has actually been submitted, this is where you will have to take another action. So if you've already participated in the pool, you're only halfway done. So once we submit a deal to you, just to continue going on with this example, you will be able to get a proportional amount of what you contributed. So if you gave 2,000 and the deal was for 200,000, right? You would end up getting 1% of 10% or whatever that works out to be. So you have to either accept or decline at that time, and you'll have plenty of time to do this. I think we have another week or so from the time that you get the deal submitted to you before you actually have to take an action. So it'll basically be, do you want to accept your load allocation? You hit yes, and we will take custody of your USDC at that time, and you'll get your load. Well, the load will start vesting, I should say, on the 21st, and we'll get to that at the end. Or you could decline if the deal doesn't sound good to you and you don't really want to participate anymore. Then you can decline, and you'll get all of your USDC back. And you can also do something in the middle too, right? Like maybe you still want to participate, but not actually for as much as you originally put. You can get partially refunded and then also get some allocation of load. It's really up to you. Nobody at this point is locked into anything. That's the one thing that's nice about ALIN. Like, we don't have your money right now. It's actually still in a smart contract that's controlled by you. It's just temporarily locked during the investment window. So as soon as we submit a deal, everybody will need to take another action again, just to recap, either accepting or declining the deal. Following that period, there may be some leftover load in the smart contract as a result of people who, decided the deal or something like that. At the very end of the ALIN pool, on like the very last day, there'll be what's called the open redemption period, where basically any load that has not been purchased by somebody else is available for anybody to buy, regardless of if it would exceed your original cap. So that's just to make sure that, we don't end up with a little dust left over at the end. And then finally, the 21st is when all this is scheduled to come to an end. And that is the day that tokens will begin dripping from ALIN into your wallet. It'll take a full year for you to get all of your tokens. However, you can sort of claim them with any frequency you want. I mean, it's just like the way like staking works or something, where you get a little bit of rewards every block. So if you want to claim them every day, you can claim them every day. If you want to claim once a week, claim once a week. Doesn't matter. If you don't want to claim it all until the 1 year's over, you can do that too. But you'll continuously accrue the load for the whole year. So I think that pretty much covers the basics of the pool. I think we can probably open up to questions and see if we can help answer some of them. So it looks like we have one question in the chat. During deal proposal phase, could vesting time frame be altered as well? There's the 1 year vesting set in stone. I don't know is the answer to that question. We really want to let the community make a lot of these decisions. We value decentralization. However, there's some framework that I feel like, as the founders of the project, we have to keep in place. But I don't know. It's something that we could talk about in governance. But I do think that based on the rest of our tokenomics plan, it really does make a lot of sense for the vesting schedule that we have. At the end of 1 year, investors, this pool of people who are participating in the ALIN pool, they will hold the absolute vast majority of the circulating supply at the end of a year, collectively. So, we don't want to set things up so that basically you guys just dump on all future people. Not to say that that's what you guys want to do, but it's it's crypto. We never know what's going to happen, and it's just better to be more long-term focused, especially in this current market. We're trying to build an exciting product, and we recognize that investors have to take a big risk, right, to essentially lock capital up for a year. And I do recognize that, and I appreciate anybody who's interested in doing it. But yeah. So let's go to another question from Vate here. During linear vesting, what is the interest percent on our vested loads, if there is any? There isn't any. So first of all, load staking is a feature that will release with V1. So V0 right now is sort of the bare bones minimum viable product version of the protocol. So you won't be missing out on the staking right now anyway. But once staking is live, yeah, you'll have to actually claim your load from ALIN and then go ahead and stake it yourself. The next question is, what is the default action in the deal phase? The default action, if you don't do anything, that's the same thing as rejecting the deal. Because eventually when we get to the open redemption period, somebody's just going to buy your allocation if you haven't bought it yourself. But like again, you're going to have plenty of time. It's going to be like a week where all you have to do is click a button at your computer, and we'll send out tons of reminders, so everybody should be fine. Next question: does the DAO will decide about LTV parameters for every asset? Yes, the DAO will decide. I mean, obviously, like for launch, it's designed by us, the team. So the inputs that are going to be there at the very beginning will be from the team, but over time, these are things that can be adjusted via governance. Next question from Benjamin: how many people on the team? There's 4 of us. Do you want to be exclusively on ARB or go also to StarkNet? Right now, I mean, our commitment is with Arbitrum. I mean, never say never about, future plans to be on multiple chains, but right now we're pretty much just focused on Arbitrum. And we have Gia's question. Since the final raise is already greater than 150,000, will that be used to vest the 10% of all token emissions? Will anything over 150K be used for liquidity pools, and that will basically be rewarded by fees and some emissions? I'm a little confused by the first part of your question. But as far as what would additional capital be raised over 150 be deployed for, it would pretty much be deployed for protocol and liquidity, and depending on how much more it is, potentially accelerated development. Potentially hiring more developers to push things along faster. Next question. We do not have a gauntlet team, such as for Aave or Compound. I'm not sure what you mean by a gauntlet team. Then we have Gia. What percentage of emissions will accrue to the 10% of tokens investors? And what percentage of emissions for other participants, liquidity providers? So like the load staking is not like a dilutive model. So like token investors aren't going to just get load emissions because they invested. The primary ways that you will be able to get load without having to buy it, like through a liquidity pool or something, would be there will be emissions for providing liquidity inside the app. So for example, we will give a subsidy for USDC suppliers to attract more capital while we're growing TVL in the early days. So let's say I put $1,000 of USDC into the dApp for people to borrow. I'll get my regular interest rate on that plus say 10% in load. So that'll be one way that you can get additional load tokens without buying them. The other way would be for liquidity providing, like for swaps. So we'll also put a bit of emissions as incentives for Sushi Swap liquidity providers. We still plan to do protocol and liquidity, but at first, I think it's still good to to also rely on the community and to incentivize some people to help provide liquidity. I anticipate that we probably will only quote unquote rent liquidity for maybe the first year or two. And at that point, we would, pretty much keep all emissions within just the app itself. The price for buying leftover tokens will be the same price. It won't affect the price. Benjamin asked, how do you plan to incentivize people to become lenders, deposit their different ARB ecosystem tokens, especially how you plan to achieve a high TVL? how do you plan to prevent a mango quotations exploit situation? All right. So the first question is, how do we plan to incentivize people? So I just kind of briefly talked about that a little bit. One of the ways that we will do that is because of the emissions that will be rewarded to depositors. So people can, sort of farm load by coming in and providing liquidity for borrowers in these different ARB tokens. And how do we achieve a high TVL, he asked. I think the same vein, we'll use liquidity incentives early on, but I think, in the medium to long term, as we get V1 finished and released, I think the product's just going to speak for itself, to be honest with you.
Pretty unique.
I think, what's that?
Yeah, I mean, the product is pretty unique and should attract liquidity by itself after all.
Yeah, exactly. I think, I think people will just be interested in using it. And I think as Arbitrum continues to grow, it'll just proliferate. And then finally, he asks, how do we plan to prevent a mango exploit situation? So there's a few things that are going on there with the mango exploit situation. And frankly, I'll be honest with you, I only have a cursory knowledge of exactly what happened. But basically, my understanding is that some guy used like perpetuals to pump up the price of some token, and then he had that token used as collateral or something and was able to borrow more than he wanted to. So specifically, how we would prevent an issue like that is, number one, there is no perpetual markets for these tokens that we would be concerned about. So the only tokens that we're going to be offering, at least in V0, that give me like any anxiety at all as far as their liquidity is concerned is Dopex and Magic. They're definitely risky assets. That is true. But there are some things we can do to reduce the risks. So one of those things is to make the loan to value ratio quite small. This is not capital efficient. It doesn't feel super great if that's what you plan to use as collateral, but it's necessary, I believe. So basically, the way it stands now, in order to borrow more than you should otherwise be able to, you would need to sort of move the price of Dopex or Magic up to 5 times its current price. So it's not necessarily impossible to do that, right? But we hope that what we've done is made such a large barrier that it makes trying to exploit it unprofitable overall. So could you do it? You could probably do it. But the idea is that it would cost you so much money that it wouldn't even be worth it to do it, because you just lose money. And then sort of just use like profit incentive there. Gia asks, what is the difference between V0 and V1 and timeline for switching over? So the difference between V0 and V1 is V0 is what we have currently on the testnet. The only thing that V0 will include that's not already on the testnet is the load token emissions through the DApp. So that's V0 in its entirety, basically. The only freedom to do anything different with V0 is that we can potentially expand our asset offerings. So we have kind of talked internally about some things we might look at to spice V1 or V0 up while V1's in development. I know there's been a few people who are wanting to see Geom be an asset. Wrapped staked ETH is also another one that's recently come to Arbitrum that could be fairly interesting. So we still have some things we can do to spice V0 up, but the real interesting parts of Lodestar really won't be around until we get into V1. And V1 basically brings the ability to collateralize your liquid staked assets. So that means, continuing to earn your staked APR on, say, Dopex or Magic, and using it as collateral at the same time, as well as load staking. So those two things are pretty much the big two that will come in V1. As far as timeline goes, I'm not the greatest person to ask on this. I think the developers would be a better ask, but unfortunately neither of them are here right now. If you're just asking me to ballpark it, I would say at least a couple months, 2 or 3 months at least. But again, take that with a grain of salt. I think the developers would have a better answer than I can give. Atreides asks, is our code base based on any previous protocols? Yes, we are a compound fork. PLV GOP proposes collateral in V1. So PLV GOP is sort of a unique one. Right now, you can use it. It does auto compound in our DApp right now on testnet. So it's like quasi liquid staked. The auto compounding part of it you're getting. What you're not getting is the Plutus emissions right now. But yes, in V1, we would look to configure it such that you would get those Plutus emissions. And Gia asks, agree that Magic and DPEX should be low LTV. Saw that happen earlier this year with Ohm on Rari. Having a higher LTV resulted in horrific cascading liquidations, even for people who had borrowing low relative to collateral. Yeah, another thing is, the four of us really are all, we all use these other protocols in the Arbitrum ecosystem, and that's what inspired us to make Lodestar. And we definitely don't want to be the reason that one of these projects gets nuked to zero over cascading liquidations. That would be the worst thing. So we're going to do everything that we can do to put up safeguards. And I think we have to be pretty conservative when it comes to those assets. Of course, at the end of the day, we will function as a DAO, but anytime, I feel that there's a proposal that is making the protocol less safe, I will absolutely speak up and summon the forces to vote it down.
Yeah, I tend to agree with you here, Quanta. If it's fully DAO, then everyone has a say in it. So if we feel that the protocol is going in the wrong direction, then of course we would speak up.
Yeah, and I'm not that worried about it. I just want to reassure people that it's not like we're just gonna. If someone were to say, "Hey, let's make the loan to value ratio 100% on Magic," we wouldn't just blindly follow that. We would definitely try to convince the community that would not be a wise decision leading up to whatever vote that we have.
Yeah, this is why I like this kind of pre-sale with the role we're getting on Discord. So at least you have the small concerned community that now starts getting involved into the DAO decisions. So it's going to be interesting to watch it grow.
Any other questions? So OX Gway asks, could you elaborate a little bit on the adaptations and improvements made to the compound fork? Sure. So V0 is architecturally is the exact same. So what we changed is the interest rate models, the types of assets we're offering, and we also had to slightly modify some of the Oracle contracts to be able to accept the PLV GLP pricing. We felt comfortable doing that because the pricing is derived from the oracles of the underlying. It's definitely the most risky oracle that we have, but it should be relatively safe based on the fact that it's derived from the individual oracle prices of like Bitcoin, Ethereum, Uniswap, Chainlink, USDC, etc. So those are the big changes that we made for V0. V1 will have considerably more adaptations and improvements. Home was kind of a rare case. System is over leverage. Yeah, okay. That doesn't seem like a question. Yeah, you can ask a question in voice, Mogi.
Hey, what's going on?
Doing well. How are you?
Good. Sorry, I'm walking my dog, so I prefer to just ask over voice. Definitely stoked for what you guys are doing. You're one of the top few Arbitrum ones I'm kind of exploring right now. But on the open period claim, so is that just first come, first serve? Where, okay, there's like, let's say 50 grand left over. Is it literally just first come, first serve? If so, is there a way to try to like cap it to say, okay, we'll do 5K, and then if they're still left over, then like, okay, now there's 10,000 first come, first serve, just so, you know, literally the first person that signs on, if they just want to ape in for like 25 grand, they kind of dominate that open session.
So it is first come, first serve. However, you still do need load pool tokens in order to participate. So there's sort of two different outcomes, and I did in one of the previous announcements from the past couple of days, I did sort of copy and paste the section of Aylin's docs that discussed this, and I sort of inserted things to do with Lodestar to make it a little bit more clear. So I would encourage you to check that out, but I'll try to do my best to give a quick explanation. So there's sort of two types of deals that we could propose. One where there's just sort of a one-to-one exchange rate. We raised $200,000 and the deal is for $200,000. So for, every $1 in the deal, there's actually $1 that's been contributed. So in that circumstance, there should be no unspoken for tokens. And there would be no way at the end for you to expend any more pool tokens to get your load allocation because you would have been out of them. The other alternative would be, like, let's say we end up raising 250,000, but the deal is for 200,000. So now there's more money contributed than we're actually offering a deal for. So in this circumstance, everybody's allocation is scaled down by the same amount. So if you gave 2,500 in this circumstance, you would actually only be able to spend 2,000 on load, and then the other 500 would stay as load pool tokens. And then those load pool tokens would be what you could use in the open redemption period to purchase additional tokens beyond your regular allocation. And then at the end, once all the load is sold, any additional pool tokens that you still have, you just exchange back for your regular USDC.
But we're still capped though at like 2,500. you can't, regardless of any of the outcomes, you can't actually acquire more than $2,500 max of
Yeah,
load.
correct. So the cap that you would be exceeding would be whatever you, after the scale down occurs, right? Your 2,500 cap may have been reduced, say, to 2,000 because of
Yeah,
the
yeah.
scale effect, but you would be able to exceed back above that is how the open redemption period works. So to go back to your original question, somebody wouldn't be able to just show up and buy $20,000 worth of them. Yeah.
Well, let's put this a different way though. So what if there's going to be members of the community that would like to spend more than 2,500, myself included, and let's say there's unclaimed, so it goes down to 2,000 each per person, and a handful of people spend the extra 500, and then a bunch of people don't spend the extra 500. Now you've got that dead money that you guys can't raise. There's some people that would say, I would like to go 3, 4, 5, but I'm not allowed to. Is there any workaround for that where you guys can actually get the capital that you have willing buyers in the market that want to provide?
Yeah. So in a circumstance where everybody's expended all of their pool tokens, or the ones that they're willing to spend, let's say, and there's still load left over, I'd have to confirm with Aylin exactly the procedures surrounding that situation. But my understanding is that at a certain point, we can just pull the remaining load out of the contract after the open redemption period is over. So, let's say if there was like 0.5% of the supply left over, I believe we could pull that out once the period is over, and we could probably do like a bond sale. I don't want to commit to anything just right off the cuff here, but personally, my opinion would be sure, I would have no problem doing that. Maybe doing like a bond sale or something like that to use the proceeds to help seed the liquidity pool. Something like that would make a lot of sense to me.
Well, I have 2 more questions. I'll try to be quick. First one, very specific on the AMM. Are you guys looking at Sushi, Uni, or Uni V3? Do you have any considerations on which pool you're going with?
I think we're leaning towards Sushi because of the simplicity. Ultimately, though, I think we want to be on multiple dexes. It's not a good strategy at first because we're going to be growing a liquidity pool, and it'll be better for all of it to be in one place at the beginning. But basically, as we've sort of learned from working on this project, to get chain link support, you need to have multiple liquidity pools in different places. And, we want to do that as a long-term thing, to have load be offered within the DApp, and even like a liquid staked version of load where you can have your load collateralized and earning your protocol fees at the same time. That's a way down the road thing, because we'd have to get an Oracle. But so we probably will eventually be in 2 places. Uni V3 probably would make sense as the secondary pool. But for now, we'll probably keep it simple and just have a regular incentivized sushi swap pool.
Okay. And then the last question on governance. So remind me, the team's getting 10% of total supply?
The team is getting 18% of the total
18%.
supply.
Okay. Yeah. Which is still in line with kind of most stuff. Where is that vesting happening? What is your guys' platform for lockup investing of your team share tokens? And secondly, are your tokens eligible for governance voting for any proposals?
So our tokens are going to be locked in a contract outside of Aylin. It's literally, it's a pretty standard like Open Zeppelin contract. I'm not sure if you're familiar with what Open. Basically, it's just like a giant repository. Yeah. So we just have a vesting contract from Open Zeppelin. We can make it public so that people can, audit themselves. But yeah, that's all it is.
And then because this is a compound fork, so is the governance I haven't used like the compound cell governance, but this will be through that, not Snapshot.
So we're going to do Snapshot. Compound governance is actually really fascinating the way they do things. And as a long-term goal, I think we want to get there to what they're doing. But there's going to be a lot of development happening on Lodestar for the first 6 months to a year of the project. And I think we can equitably use Snapshot for governance while keeping the team fairly nimble.
Not yet.
Because, sorry? Oh. Anyway, so I think we want to stay on Snapshot at first because it keeps the team fairly nimble. Basically, in order to make changes to the compound code, using the compound governance model, the one that they have right now, it involves like a time lock contract, which is the admin of sort of all of the contracts that make up the protocol. So you have to like submit the code to the time lock contract, and there's certain parameters that govern that, and you have the vote, and then there's a time period where things take to be implemented. So it's sort of a big process. And while it's a really cool process and like it's definitely like the ultimate form of decentralized governance, it's laborious, and at a time where we are still rapidly developing things and putting things out, we want to kind of keep the chains off us a little bit and just use Snapshot. But as a longer term thing, being able to go to the time lock model and sort of completely decentralize things, and for example use load incentives like grants from the treasury to sort of reward people who are contributing to governance through the time lock, like that would definitely be a really cool end game for us.
For sure. No, I mean, I think at this stage, simpler is better. You want to get off the ground first before you add all the complexity. Sorry, did you say though that the team's tokens are going to be eligible for governance? So how does that work in your contract? Are you adding?
No, so sorry, yeah, no. So the wall locked, basically like the Snapshot voting right now. There's different ways of doing it, right? Like you don't necessarily have to have it as being a proportional weight. There's a few options with Snapshot. We're still exploring the best way for us right now. But no, the tokens that will be locked in the Open Zeppelin contract will not contribute towards governance. But there's a few models for governance where you just need to have a token to participate. So it's pretty straightforward for us to acquire tokens even without having our tokens vested to us.
Yeah, I would just say it's a balance. I mean, I think projects struggle where with your token launch, you want to go decentralized because of obviously the securities implications. But from a team and roadmap direction, I think you want to keep more of that power early on, and grow into that community-led decision making. So I think it's a delicate balance. That's where my concern was going to be. If you guys had 18% of all voting shares, then we know it's effectively just on paper there's everyone can vote, but in reality it's the team voting. So I think it's good that you'll try to strike that balance, right, where you will have the ability to participate a material amount of voting share, but also allow the community voice to kind of be heard as well. So I appreciate all the answers. That's it.
Sure, thank you. Thanks for the questions. Anybody else have any questions for us?
Yes, Salman was asking about oracles and redundancy. If you have any point on that, Quanta.
Yeah, this is again sort of more. If you want a more technical answer, I'm not the person for that question. Apple and Coops are the developers for the project. I don't know is the answer. I don't know how it works. I'm not. I'm not the technical guy on this kind of stuff.
Yeah, it's based on the chain link feed,
It is a chain link feed, yeah.
but redundancy not yet.
So I can what I know the basic process flow for how the PLV GLP Oracle works, but I don't really know the the technicalities. So basically, the way it works is GMX prices all its products, all its perpetuals with Chainlink, and then GLP is an index fund that holds all of these assets. So GMX has sort of a contract that looks at like the current amount of tokens in the GLP contract. So it knows there's 1,000 Bitcoin and 10,000 Ethereum and blah 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 blah. So it just basically counts all those tokens that are in the contract making up GLP, and then it just basically multiplies the amount of tokens by the Oracle price and sums all those numbers up, and it reports like a total value of all GLP. Like this is just a contract call that you can make to like straight to GMX. It's just like a read contract, and then you can divide that number by the amount of GLP in existence, like the actual GLP tokens. And that gives you a price in dollars of GLP. And that's what we're doing. There's like a couple of built-in safety features. Number one, you can't really flash loan GLP because there's a 15-minute hold period when you buy GLP. Like you can't buy GLP and then turn around and immediately sell it, right? You know what I mean? Like when you buy GLP on GMX, like you have to hold it for 15 minutes before you either put it in the Plutus or whatever, or sell it. And then also, once it goes into Plutus, the price of PLV GLP can only go up relative to GLP. Like it doesn't matter like what happens. Like the markets could be crashing. It just doesn't matter. Just the way things are set up, like PLV GLP's number only goes up. So there's no risk. There's no risk of that exchange rate becoming like depegged or something. It can only move in one direction. So that's basically the basic flow for the PLV GLP pricing. But if you want a more technical answer than that, you're gonna have to try to talk with Coops or Apple. Yeah, number go up technology. Yeah, it's just because of the just to specifically look at the vault, right? When you leave the vault and Plutus, like it's not like you're swapping through a liquidity pool, right? It's more analogous to staking than it is a liquidity pool. Like when you unstake, you're just unstaking like your relative share of GLP. But the amount of GLP relative to PLV GLP tokens is always growing because of the compounding nature of it. They take ETH, they buy more, they put it in the contract. That only goes in one direction. Like they're never taking GLP out of the contract relative to the amount of PLV GLP in it. Yeah, a redemption. That's one way of looking at it. Yeah. It's definitely not like a liquidity pool, which is honestly what makes the vault such a powerful architecture. What are the plans to the 7% of the supply that we have not allocated yet? Well, if I was going to tell you guys, then I would have probably put it in the tokenomics section already. But in all seriousness, we're not going to leak anything on that just yet. We'll have some news on that shortly after launch. But what I can say is that it'll be an exciting thing for the community. You'll be happy with it. Any other questions? Well, if there's no more questions, we'll give it a couple minutes. But I'd like to say thank you to everybody who's participated in the ALN pool already. And if you're on the fence, I would totally welcome you to come aboard with us. I hope you do. It's going to be an exciting 6 months to a year. I know you're going to be along for the ride if you participate through the ALN pool. I know that we are definitely in some treacherous territories in terms of the global market, but Arbitrum is going to be a really exciting blockchain. We're all going to make it. We'll be okay. I think we're raising at a pretty modest valuation, and if we deliver everything we're setting out to deliver here, this protocol is going to create a lot of value, and it's going to cement itself as a pillar of the Arbitrum DeFi ecosystem. Plugging into all these native projects just don't have these type of services right now, and the ability to borrow and lend, it's just an absolutely critical part of DeFi. So, thanks so much, and we'll go ahead and wrap it up here.
Yeah, thank you guys.